Thank you very much. Now I ask Mr. James E.A. Turner, Vice Chairman of Ontario Securities Commission, to make his presentation. We discussed the matter of bilingualism in Canada, and he prefers to speak English. He's not from Quebec, but from Ontario.
Good.
Please.
Mr. President, distinguished guests, good morning. I want to thank the Capital Markets Authority of Kuwait for inviting me to this symposium. On behalf of our market regulator, the Ontario Securities Commission, I extend greetings to you all. It's a pleasure to attend this event and get an opportunity to discuss these important issues with members of the international community. Let me depart a little bit from my formal remarks so that we have more time for questions and discussion. I wanted to, and I should say that my original remarks we will post on the website, so if anyone has an interest in some of the more detail, that will be available. Let me just step back a little bit and pick up a couple of the themes that you've already heard from other speakers. First of all, the recent financial crisis, there were a number of causes and contributions to that crisis, but one of those important contributors was the failure of boards of directors to identify and manage risk. So risk is, and the management of risk is a key issue for corporate governance, for corporate governance frameworks. I should also say that as securities regulators, we are also focused on risk, both risk in the capital markets that we have to ensure are being appropriately addressed, and of course the risks that we have as a regulator ourselves. I think you're going to find a number of the themes and issues that other speakers have identified to be certainly consistent with my remarks. I did want to indicate to you that our bank regulator in Canada issued last week new guidelines for corporate governance with respect to financial institutions. And they are very interesting guidelines now applicable to financial institutions in our jurisdiction, and they focus very much on the role of the board, the role of management, and how a board appropriately manages risks that apply to a financial institution. So with that introduction, let me very briefly just give you a high-level overview of what we as securities regulators do in terms of regulating corporate governance matters. And it all starts with our securities regulator mandate, which is to provide protection to investors from unfair, improper, and fraudulent practices, and to foster fair and efficient capital markets. Obviously, our Canadian capital markets are integrated and interconnected with markets around the world. I should say one of our roles as securities regulators is to supervise the Toronto Stock Exchange, which is the largest equity trading market in Canada. So our approach to corporate governance is a principle-based approach. That we have established principles over the last few years that we expect our reporting issuers to comply with. They tend not to be prescriptive rules, but rather guidelines and issues and matters that issuers are expected to address in their financial disclosure. The one area where we have a mandatory rule is with respect to our audit committees. I think you've heard from other speakers the importance of the audit committee as part of the corporate governance framework. We have specific rules requiring that audit committees be composed entirely of independent directors, and that the audit committee take a very active role and be responsible for supervising the outside auditor. Apart from that, however, as Mr. Berg indicated, we take a disclose and explain approach to corporate governance. So we articulate principles and practices, and we expect and require our issuers to issue a public disclosure describing how their practices are consistent with the basic principles. Our objective is to ensure that investors receive consistent disclosure and material information on a timely basis. Shareholder rights are important to us as part of the governance framework. Our regime is focused on and designed to protect shareholder rights generally, but also as part of change of control transactions and conflict of interest matters. So we as securities regulators have taken an active role in the governance area. We will intervene in mergers and acquisitions and significant related party transactions if we conclude that those transactions are going to be abusive of either our markets or our shareholders. We provide guidance to market participants with respect to what we expect from them in terms of governance rules. And we encourage improving shareholder access to proxy-related materials, including voting. This last October, the Toronto Stock Exchange implemented new rules that focused on the election of directors. And so those new rules applicable to public companies listed on our exchange include a requirement to elect directors annually, to elect directors individually and not by slate. We require that issuers, the rules require that issuers indicate whether or not they have a policy with respect to majority voting for directors, meaning a director has to receive a majority of votes or will not be elected. And we also require public disclosure of the voting results with respect to the election of directors. I was going to comment on the Sino Forest collapse in our jurisdiction. Sino Forest was an issuer on the Toronto Stock Exchange that had a market capitalization of about $6 billion. In June 2011, the company's price plummeted after private analysts made public certain allegations with respect to it, and that company is now in receivership. But the relevance of this really is that, having looked at that specific circumstance, as regulators, having investigated Sino Forest, we then did a review of 24 selected public companies from emerging markets. As a result of the review of those companies, we found a number of governance problems, and as a result, we took various actions against the various companies, but we also issued a guide for companies operating in emerging markets. The guide is intended to provide assistance to emerging market issuers and their directors and management on their governance and disclosure responsibilities. The guide identifies 8 areas that we consider important. Certainly, I'll focus on a couple of the issues from a key governance point of view. Our guide emphasizes that a company's board of directors and management must have a thorough understanding of the political, cultural, and legal circumstances in the jurisdictions in which they carry on business. We made clear that we require Canadian regulatory requirements, including governance requirements, to be complied with by all issuers, regardless of where their business and activities may be. We had some concern with respect to corporate structures. As Professor Kirchner has indicated, special purpose entities, complicated structures cause us concern, and we require that boards of directors carefully consider the implications of those structures. We also identified related party transactions as an important issue. We require boards to identify conflict of interest matters, and with respect to significant ones, we require shareholder approval of those related party transactions. So, as I indicated, risk management is an area where the board should be particularly focused. Our guide says boards should have a clear understanding of all the risks associated with operations in an emerging market or any other market, and how those risks impact operations. Boards should consider the risk analysis and mitigation techniques that may be appropriate in a North American context, but they should recognize that those techniques may be less effective in emerging markets. We consider disclosure of those risks to investors to be an important element of investor protection. One of the other areas where we indicated some concerns was with the responsibility of directors for internal controls related to financial information. Consistent with the themes you've heard, we, in our guidelines, indicated the importance of the role the board plays in supervising the external auditor and in decisions with respect to who that auditor may be and what kind of audit plans they will develop. To conclude, these have been very brief remarks about a number of the issues addressed in the guide we issued. It's available on our website. It's received extensive positive feedback in our jurisdiction, and we're very encouraged that a number of the issues are cascading down to the board of directors and to our issues. In conclusion, Sino Forest was an example of the case where securities regulators felt compelled to investigate in another jurisdiction compliance with our own rules. A number of concerns came to light as a result of that investigation, and as a securities regulator, we took steps to address both the specific challenges and the issues with respect to corporate governance raised by it. So in our view, corporate governance issues play a key role in promoting financial market stability and integrity. Boards of directors have a crucial role in ensuring that governance requirements are effectively addressed for the protection of investors. We understand that the specific corporate governance rules may vary among different countries, but the underlying principles are important and must be consistent internationally. We think in Canada we have a regime that is consistent with the kinds of standards that Mr. Berg indicated. Those frameworks should promote investor protection, market integrity, and capital market formation. So with, that was a bit of an abbreviated review of my formal remarks. I thank you for your attention. I look forward to any questions you may have. Thank you very much.
Thank you very much, Mr. Turner. You have reminded us that in the financial sector we have three financial markets: securities, banking, and insurance. And we have different models of regulation in various countries. For instance, in Germany, we have an integrated regulation of all of these three markets. And you have brought into play guidelines which contain not prescriptive rules, but on the other side, you pointed to the fact that there are mandatory rules as well. For instance, the audit committee. And this reminds us that in the background, there is extraterritorial application of US law, the Sarbanes-Oxley Act. So these are, in most countries which want to have access to the US-American market, more or less mandatory. And on that bottom line, we can then develop guidelines, non-binding corporate governance codes, and so on. So